Hi, I'm Shae Russell from ABC Bullion, and joining me today from his home is none other than Jim Rickards. Jim, how are you?
I'm fine, Shae. How are you?
Good, thank you. Look, it's great to see your face. I'd much rather be talking to you in person, but
Right?
unfortunately, Australia still has these borders in place.
Yep. Yeah, it's hard. The international travel is coming along a lot more slowly than domestic travel. So it is. It's hard to make plans. It's hard to get around.
That's okay. Hopefully, we'll get to meet in person soon. Now, I've brought you on today because obviously, when it comes to talking about gold, look, you've been talking about gold long before it was popular, but you are one of the experts on gold. So, we're going to delve into gold and the monetary system later on. But I want to kick off with a really topical question today, and that's this inflation deflation debate. Now, everybody seems to be spooked by some of the PCE numbers that came out recently. But does this really mean that it's is inflation here, is hyperinflation here, or is this sort of more a flash in the pan statistic that we can overlook?
Right. It's a great way to frame the issue, Shae. And this is the biggest economic debate, I'll say, going on in the United States right now, but really around the world. It affects everybody. For better or worse, the U.S. is the largest economy in the world. The dollar is the leading reserve currency. So what goes on in the United States affects the entire world. And yeah, it's the great inflation debate, inflation versus deflation debate. I've participated in some panels on that, and others have as well. And you can't open a website or look at any financial journalism without hearing about it. And it's a big deal for a lot of reasons. It affects investment decisions and net worth and portfolios and so forth. But look, if you knew inflation was coming, if you were sure of that and that's what was going to happen, you would know exactly what to do with your portfolio. If you thought outright deflation or even disinflation, just a declining rate of inflation heading towards zero was coming, you would know exactly what to do. But the point is, when it's up in the air, when it's up for debate, both sides are sort of having their day. And I say the everyday investor is sort of sitting there saying, what's it going to be? So I would say right now, the inflationistas, as I call them, have the upper hand. I don't mean substantively, but I mean in terms of the debate. There are far more articles, commentaries, keynotes, interviews about inflation, and they have some data on their side. I mean, it's not just made up. The April inflation numbers, and take your pick. We have CPI, PPI, PCE, core, non-core. I don't have to get into all those definitions, but we have 5 or 6 prominent measures of inflation, not to count all the more esoteric ones. But they were all hot. They were all hot in April and May. Some cases the highest in 20 years, 10, 15 years in some cases. And so the inflationists say, well, there it is. There's the data. It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. The great, bond market crash that they've been talking about for 40 years, because the bull market started in 1981. I was there. It's still going strong, but is this the end of the bond bull market, et cetera? And then, of course, ramifications for gold. So if you thought that was true, you'd probably buy commodities, real estate. You would not want bonds. You'd be dumping bonds. You'd probably buy stocks. You'd be dumping gold, et cetera. There's a whole set of things you would be doing. At the same time, the deflationistas, and I'm in that camp, or disinflation as the case may be, that's more my view. I'm trying to be fair to the other side, but the view there is that, yeah, okay, April and May were hot, no question about it. The data is right there. But the first thing you have to discount for are what are called base effects. When the U.S. reports inflation, everybody knows the headline number, is 3.6% or 5. I'm pulling numbers out of a hat, but it was high. It was kind of in that 3 to 5% range. But when that's reported, it's year over year. So that when you hear a May inflation number, it's May 2021 compared to May 2020. When you hear the April inflation number, it's April 2021 compared to April 2020. Well, what was happening in April and May of 2020? The greatest economic collapse since 1946. In other words, prices were plunging. Airline tickets, well, the airlines weren't even flying. So you tell me what a ticket costs. Housing had a collapse. March 2020, the stock market collapsed, et cetera. So prices were dropping. So a year later, of course, they're going up. You would expect that. And a lot of that is not kind of new inflation or sustainable inflation. It's just the fact that you bounced off a really low number from the year before. I compare it, you fall in a 50-foot hole, you climb up 50 feet, but you're back where you started. So nice going with the climb. You did climb up 50 feet. That's a real number, but you're back where you started. So, and it's very difficult to estimate the impact of the base effects, because what's the base? Do you know, what would the inflation have been if we didn't have a crash? Well, no one really knows the answer to that. Some analysts go back to 2019. They say, well, let's not do year over year. Let's look at a 2-year frame, because 2 years ago the pandemic wasn't here, and you divide it by, divide in half, you don't look at 2 years inflation, but use 2019 as your base. That seems like a legitimate method. Other people are using estimates, etc. But the bottom line is that the best estimates I've seen are the base effects account for about half of the reported inflation. So if you see a number like 4%, and that's about what it was really only 2% kind of new inflation and 2% base effects. The importance of the base effects is not that it's not real, it's that it's not sustainable. Because what's going to happen, we're going to get to August, September, October of this year. At that point, your year-over-year comparison is going to be August, September, October 2020. Well, guess what? The economy grew 34% at an annualized rate. In other words, not only is there not going to be a base effect in the negative sense, you're going to see some strong numbers from the year before, which is going to make the year-over-year comparison much more tame. So just looking at that, also looking, remember, inflation is a basket. Americans tend to judge everything by the price of gasoline. So they go to the pump, and gasoline used to be $2.50 a gallon. Now it's $4.50 a gallon. They go, see, there's your inflation. Well, gas prices are up. Again, you can have your opinions, but you can't make up your own data. Gasoline prices are up. Prices at the grocery store are up. But then people forget, consumer electronics are down. Tuition is down. Healthcare is down. Clothing is down. So it's a basket, and the number was hot. Strip out the base effects, and it was a little strong, but not nearly as much as it was before the base effects. But it's a basket of things. Some went up and some went down. So the things that were going up, independent of base effects, automobiles. Well, guess what? Automobiles are basically computers on wheels. The reason automobiles were going up is semiconductors. We couldn't get the semiconductors from Taiwan. Taiwan's the main manufacturer. Well, you look around your kitchen, your refrigerator has semiconductors. Your coffee maker has semiconductors. Your automobile certainly has semiconductors. So a lot of the things that were going up, consumer durables, automobiles, et cetera, it wasn't because they couldn't get steel or Freon or whatever they need to make refrigerators, because they couldn't get semiconductors. Well, that's temporary. It's a big deal. So there are supply chain delays, but they're being worked out. So between the base effects, which are definitely temporary, and the supply chain effects, semiconductors in particular, which are likely temporary, and strong growth in the third quarter of 2020, which is going to be your base when we get into the third quarter of 2021, this inflation is just going to go away. That's my view. There are other people who disagree, but it's a big deal because it affects, if you really thought inflation was going to go away, and in my view it is, then you're going to buy bonds. You're going to buy the 10-year Treasury note. The residential real estate is probably going to go up. That's hot. But then, of course, what about gold? You say, and gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer, August of 2020, is as the yield to maturity on the 10-year note goes up, gold prices that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, because I'm right about disinflation, then that weakens the dollar, and the dollar price of gold goes up, because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury note. So just to kind of wrap it all up with a bow, what's been going on with the 10-year Treasury note? And here's my, you think of this as a game of bridge, or we have a game called pitch, which is like a poor man's bridge. But here's my trump card, which is what's going on with the 10-year Treasury note. The answer is it's going down. It peaked at 1.745% on March 31st. Today it's around 1.475%. That's 30 basis points. That's a big deal in bond land. So the bond market is telling you that inflation is not real. It's real so far, but it's going away. The bond market's looking forward. It's saying the inflation is not sustainable, and therefore the yield of maturity is coming down, which it is. That's a fact, and that should be very bullish for gold prices, notwithstanding last week's gold hit an air pocket for reasons having to do with expectations, and a central bank that doesn't know what it's doing. But that's a separate topic.
Actually, it's a perfect lead into my next separate topic, a central bank that doesn't know what it's doing. So last week, the Fed came out and it did spook markets. For so long, the Fed's been talking to the market saying that there's no way they're going to raise rates until 2024. And yet there were 7 out of 18 board members, I believe, that said they believe rates are going to raise as soon as 2023. Now, the markets had a bit of a panic. As you said, I've used other words to describe gold's incredible drop, but air pocket's probably more appropriate for going to air. So what have the Fed gone and done? They've gone and spooked the market. But is this a reactionary measure to the supposed inflation that probably won't be there by then? Or was this about explaining to the market that, perhaps they got it wrong and they do need to bring rates down, or rates up, sorry?
This is about central bankers pretending to know what they're doing and pretending to have some influence when they actually don't. I've never seen a time where the actions and comments of the central bank mean less. The 10-year note, yield to maturity, that's a big deal. The price of gold, that's a big deal. Stock markets, they're all a big deal. Look at all the. If you want to waste time listening to the Fed, be my guest, but I don't. I guess I do. I mean, I'm aware of it. I analyze and I write all the time, so I have to pay attention to it, but I don't give it much weight. I'll put it that way. I'll give you a couple inside tidbits that share with your audience that they probably won't hear anybody else, but I have one friend, I can't mention the name, but a true insider. Let's just say he probably sat in Janet Yellen's lap when she was the chairman, and Ben Bernanke before that, and now back with Jay Powell. So not a member of the board of governors, but an insider's insider. And he told me once, he said, Jim, nobody takes the dots seriously. The dots are when every member of the FOMC, whether you're governor, regional reserve bank president, or they're the members on a rotating basis, they put a dot where they think inflation is going to be, interest rates are going to be, growth is going to be, and when. So it's called the dot plot, and you got all these dots in it. He said, we wish we'd never started it. We thought it was a good idea at the time. We wish we'd never started it. Nobody takes it seriously. Nobody inside the Fed takes it seriously. The media talk it up, to no end. But so you can just throw the dots in the garbage. But they don't even take it seriously inside the Fed, number one. Number two, the Fed's now thinking about raising rates in 2023 instead of 2024. The Fed doesn't know what's going to happen this fall. The Fed can't tell me what's going to happen in September. I just told your audience what's going to happen in September, which is inflation is going to cool down and bonds are going to rally. But the Fed doesn't know that. They have the worst forecasting record of any financial institution in the world, with the possible exception of the IMF. But I think the Fed is actually worse. So every year, the Fed gives a 1-year forward forecast. So in 2010, they said, here's what's going to happen in 2011. 2011, here's what's going to happen in 2000, and so on. So it's a strip of 1-year forward forecasts that they do every year. They have been wrong every single time by orders of magnitude. In other words, if they said growth is going to be 3.2% and it was 3.1%, I would say, hey, nice going. You guys stuck the landing. That's awesome. Who cares? But they'll go through. They were saying 3.2%. It was like 1.8. And then they say, oh, man, maybe we got to lower it a little bit. And they go 2.7, and it was like 1.7. I mean, they were just not even close for 10 years in a row. So, and again, you can look this up. It's all available online. They don't talk about it, but I will. And my point is, with a forecasting record like that, why am I supposed to think you know what's going to happen in 2022, 2023, or 2024? You don't. Now they talk about it. I mean, the only central banker who actually knows, he knows that none of them know what they're doing, but he does a fabulous job of pretending. He's Mario Draghi when he was head of the ECB. Nobody, I don't know if it's the Italian actor thing, but nobody was better than Mario Draghi at pretending he knew what was going on. The only central banker who actually does know what's going on, she's the best central banker in the world, is Elvira Nabiullina, who's the head of the Central Bank of Russia. She's increased Russia's gold allocation to 20% of total reserves. So you look at Russia's reserve positions, publicly available. Let's go to the Central Bank of Russia website. Their reserve position is 20% gold. So in round numbers, it's about $500 billion, of which $100 billion is in gold. If you look at the ratio of gold to GDP, and that's, of course, Russia doesn't have as much gold as the United States, but they have 1/4 the gold that we do, but their economy is only about 1/8 the size. So relative to the size, they have twice as much gold as the United States. So she knows what she's doing. She's about the only one. The rest of them, I mean, Reserve Bank of Australia, the Federal Reserve, Bank of England, ECB, Bank of Japan, they're the worst, but none of them know what they're doing. But they have to sort of protect their fundable on the job, so they go through all the motions. But the point is, the Fed doesn't know what's going to happen in any of those years, and so, but they felt they had to do something. And because of this inflation narrative that we already talked about, can't actually influence anything but except psychologically. So they were worried not so much that real inflation was coming substantively, but that inflationary expectations would get out of hand. That can become self-fulfilling. If you and I and everyone else actually does believe inflation's coming, we might start to act that way, and actually inflation might come because we're acting that way. That's called the self-fulfilling prophecy. The great Robert K. Merton came up with that phrase in the 1940s. So they were a little bit worried about that. So they felt they had to put on a show. Like, we're going to tell the world that we get it, that we're just as worried about inflation as they are. And maybe we'll raise rates a little sooner, and maybe we'll start a little bit of a taper. But all they were really doing was playing to the audience. They were just letting the audience know that they were kind of concerned about it. And so, but the market just got hit, between the eyes. It was like, oh, well, here come the interest rate hikes, and here comes the taper, and so inflation must be real. So, interest rates soared very briefly. Gold took a nosedive. Stocks went down, and then they went back up again. But most of the action, the damage, I'll say, was in the bond market and the gold market, which is where you would expect it. It lasted about 2 days. It was serious. It was real. Interest rates turned on a dime after kind of going back up to 155. They're back down to 145, give or take. Gold has not made a full recovery. It's made about a half recovery. It dropped from I think it was around, earlier it was around 1860. It was, I think, 1830, the day of the Fed's announcement. Went down to like 1725, give or take, in US dollars. Now it's back up to 1775. So it's made a partial recovery. It will regain the rest of what it lost, but it might take a month or so until we see the data that I'm talking about. But if beginning really now, because the next data we'll get early July, we'll get the June inflation, which will be June over June. But June 2021 over June 2020. June 2020 was, hard to do it by month, but the very end of the pandemic recession or the beginning of the pandemic recovery is right on the edge. So it might be a little bit hot, but not as much as May. But starting in July, August, September, when the U.S. economy was growing at an annual rate of 35%, you're not going to have those base effects. And you're going to have some of the other headwinds we talked about. Inflation is going to cool off a lot. Bonds will rally and gold will rally.
I'm going to just draw on a little tidbit you said in there when you were talking, just to expand on something briefly for the audience before we start talking about one of your books. You mentioned there that Russia has now accumulated 20% of their foreign reserves in gold. Could we make the case that the Russian central bank is de-dollarizing?
Yes, because there's other evidence for it. So the acquisition of gold is one aspect of de-dollarization. You're exactly right, Shae. But the other aspect is look at how many treasury bills they own, because they have a lot. They're always going to have some dollars. They're actually always going to have a significant amount of dollars because they sell oil, and oil is priced in dollars. So if you're selling oil, you're getting dollars. Then the question is, what do you do with the dollars? So they're always going to have some, and they should. But they spent 12 years from 2008 to 2020 acquiring gold, and they had the level of gold that I described. But now they're diversifying into euros, euro-denominated securities, Chinese yuan, because they have a very large bilateral trading relationship with China. And of course, we mentioned gold. And they still have, they still have a dollar position, but they've reduced that in the central bank balance sheet. But they also have a sovereign wealth fund. I don't recall the exact name of it. It's something like the Russia Fund for the Future or whatever. But it's not the central bank reserve position, but it is a sovereign wealth fund for the benefit of the Russian people. That has completely de-dollarized. They have no dollar-denominated securities at all. And there are two reasons for that. One is as I said, I expect disinflation for the rest of this year, maybe into next year, into 2022. But if you said, hey, Jim, give me your best outlook for 2023, 2024, the inflation is coming. It's not coming in the next 6 months, might not be coming in the next year, but if you go that far out, it's coming because there are more powerful forces at work that have nothing to do with central banks. And here we're talking about demographics. The global population in the developed economies and the major developing economy, which is China, is collapsing. So if growth, there are many definitions of growth, but the simplest definition is people and productivity. How many people are working and how productive are we? That's nominal GDP. It's pretty simple. Well, productivity has been flat to down, and economists are not exactly sure why. But if the population is declining, if the working age population is declining, so you have a two-factor model and they're both going down, tell me what's happening to growth. It's not there. But you say, why is that inflationary? Well, it's inflationary because you're going to have to pay more in wages to get workers because there aren't as many workers. So Russia, they look. What's the national sport of Russia is chess, right? So they're very good at looking ahead. So they're saying you're going to have to inflate the dollar. And again, to be clear, it's not coming this year. It might not come next year. But eventually, the U.S. is going to have to figure out how to inflate the dollar because it's the only way out of our debt problem. And that's the American way. Just here, I'll pay you back, but good luck buying a loaf of bread because your money's not worth very much. That's the American way. We're not so good at it right now because the central bank forgot how to inflate. But by the way to do it is to raise the price of gold, just to kind of jump ahead. But they'll figure that out eventually. It's in my book, my new book, by the way. So, but the point is, the Russian knows that. So why would you want dollars if they're just going to be inflated? What would you want? Well, you would want gold, and they've got it. And you'd want oil, and they've got that. So what's interesting about Russia, about 5 months ago, after buying gold every month, like clockwork, for 12 years, they stopped. They haven't bought any gold in the last 5 months. Well, what does that mean? Does that mean they hate gold? No. What it means is that they have enough. Think of yourself as a hedge fund trader trying to run a hedge book. So you have 20% gold. You can see with the benefit of hindsight that was their target, and they hit the target. So they stopped buying more gold. But if they're wrong and I'm wrong, and this long-term inflation doesn't come, I believe it will, but if it doesn't come, you wouldn't want any more gold than that. But if the inflation does come, what's going to happen to the dollar price of gold? It's going to go up a lot. So in other words, the gold as a percentage of their reserves can increase without buying a single ounce of gold just by watching the price go up. So you can see the brilliance of that. I mean, they've got 80% securities and 20% gold. And say, oh, I want more gold. Well, don't do anything. Just wait for the price to go up, and your percentage of gold is going to go higher. So they've got this, and then they've got oil as well. They've got this thing figured out. No other central bank or reserve position manager in the world has done quite the same. The Chinese are trying, but the Chinese have other problems. So Russia's where you should be. And I've never said, you know, people always put words in your mouth. People say, Jim Rickards says, sell everything and buy gold. I've never said that. I don't believe it. I recommended 10% allocation. Okay, Russia's 20%. Good for them. I don't have oil fields in my backyard, but they do. But the point is, pick a number that you're comfortable with: 5%, 10%, 20%, and get to that number. And then sit tight. You're protected. You're hedged. If gold goes down, you wouldn't want it anymore. And if it goes up, you're going to do fine. And those gains are going to be large enough to protect you against the losses, potential losses in other parts of your portfolio. So Russia's done this perfectly. By the way, the U.S. has done it pretty well. We just don't talk about it. We do. Just a trivia question. Most people don't know this, but if you say, well, what percentage of the United States reserve position is in gold? The answer is 70%. We're not slackers. Now, the U.S. is a little different because we print the leading reserve currency. We kind of don't need reserves. Like, we don't have a bunch of euros and yen and stuff. We have a little bit, not much, but we don't need it because we print dollars. But we're 70% gold. So the U.S. won't talk about gold, but we're in pretty good shape as well. I fear for places like Canada. I think my gold position is larger than Canada. They sold all their gold. And Australia has sold a lot of gold. Now, Australia and Canada, what they say is, well, we have gold in the ground, which they do. And if we need to mine it, we can, which is true. But unless you want to expropriate it, it doesn't mean you've covered yourself financially, because the price could skyrocket. But so I think Australia, Canada, some other countries, the UK, are a little skinny on the gold side, at least in terms of reserve positions. The US is fine, Russia's fine, China's getting there. But it's almost as if the world is sorting itself into people who have gold and people who don't. But even though all these central bankers will never admit, I mean, what I just described reality. I mean, those are all facts, but you'll never get a central banker to admit it.
So that perfectly leads into my next question. Now, you're a prolific author. You've got many books out at the moment. So I've been doing some historical reading of how we wrote about gold in the 1970s when Nixon removed the gold backing from the US dollar. So I've got some really old gold books here. It's interesting how they talk about gold and how, when these books are written in the early 70s, inflation and stagflation hadn't yet taken hold of the US. Then we've got a new case for gold that you wrote. Now, I would say, having read these ones, this book perfectly encapsulates what happened in the 70s. However, you're really still making the same argument to own physical gold in this book from these books that I've been reading that were written 50 years ago. Tell me, how have people decoupled from understanding gold? And obviously, I think they should actually go get your book so they can understand even more so why they should own physical gold. But how did we decouple over the past 50 years from understanding the importance of gold in our portfolio to now less than 1% of Australians own it?
Right. That's a great question, Shae. And I do cover that in the book, The New Case for Gold. I keep thinking that archaeologists will unearth some site near ancient Babylon, and we'll find the old case for gold. We'll find clay tablets talking about the benefits of gold. I'm not sure the argument has changed much in 3,000 or 4,000 years, but here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971. And I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, as you point out, Shae, was when Nixon stopped redeeming dollars for gold. It was the Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more, and then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States, and sterling, I think it was $4.75. It could be off a little bit on that, but it was 4 pounds and change. And And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be like a $500 bill, so it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan, or all around the world. So gold was actually money. So it wasn't a question of, oh, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, oh, a sovereign, that's 8 grams of gold, so that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, well, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War's not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System, bearing in mind the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets, and the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on 2 Army bases, West Point and Fort Knox. So I would say the Army has the gold. But my point, Shae, is that the gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course, it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the U.S., we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half. No, seriously, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a financial, a monetary institution. Australia sold most of theirs. Canada sold most of theirs. But the U.S., if I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold an ounce since 1980. But it's a long story, but it's all in the book, The New Case for Gold.
Absolutely. And I think every gold investor should read it, no matter where they are in their gold journey, because it gives you a really good, obviously, example of what happened and where it's going. Now, before we wrap up today, I'm just going to touch on another book that you wrote last year, which is The New Great Depression. It's been quite well read, and there's little flags and highlighter all throughout it. Now, this was one of the first books that came out last year that combined a health crisis with an economic crisis. So you were one of the very first to make those connections. Now, one of the things you talk about in the book, it's interesting that you mentioned that, talking about your gold book, is you're talking about the slow economic transition, the multi-generational effects that the pandemic is going to have on society. Are you seeing those starting to play out as you wrote in this book last year?
Yes, and I guess every author is proud of his or her book, and I'm pleased with this one. But that book was tough to write. Now, it came out in January. It was supposed to come out in October, but there were supply chain delays in the printing industry, not the publishing industry, the printing industry. They couldn't get the books done. So that was pretty much baked by late last summer. So the writing's a year old. I updated a little bit in October, came out a little bit more recently. But I said things in the book that were really, really leaning forward at the time, although the evidence was there, that have totally been borne out. And I went out on a limb a little bit, although I was careful about what I was doing. I said that virus came from the laboratory in Wuhan. I wrote that in the spring of 2020. And the evidence, I wasn't guessing, the evidence was there. It was ignored. In the US, everything was politicized. It was like, well, gee, if Donald Trump said it came from a lab, then we hate Donald Trump, so it must have come from the wet market. That was about as sophisticated as the American media got. But the evidence was clear from the start that it came from the lab. Well, now it's conventional wisdom. Everyone's, oh yeah, it came from the lab. And I said, well, okay. But I said that a year ago. But the other thing I said was that the effects of this would be intergenerational, the behavioral effects. This is now kind of segueing from the pandemic to the economy. And the book covers both. And they've actually given it a name. I described the phenomena, and I based it partly on what happened with the Spanish flu in 1918. There's a lot of more recent literature on that. But I described the phenomena. I didn't give it a name, but today it has a name. They call it long COVID. And long COVID is a name that says, hey, maybe the pandemic's over, maybe the caseload's way down, the fatality load is way down, we're not doing the lockdowns, we're not doing the masks, but the effects are lingering. And if you had it, some people are physically affected by it for an indefinite period of time. They maybe they're up and about, but they have lung problems, they have brain problems, they have aches and pains, et cetera, that they're not like physically over it. Number one. Number two, whether you had it or not, we were all locked down. Nobody was unaffected by this. Some people had it. Some people had worse cases than others. Even people who didn't get the disease were affected socially, mentally. Social interaction dried up, travel dried up, all the things humans. One of the main things humans do when we just walk around, we look at people's faces. We're all body language experts. You know, are you smiling? Are you frowning? Are you friendly? Are you mean? Good mood? We just do this intuitively by looking at basically facial expressions and, you know, other parts of the body. Well, how do you do that with a mask? You can't. And so when you got a mask and a hood, and that's not, I'm not talking about gangsters, I'm talking about everyday people. So all of a sudden we were deprived of our cues, our read on body language, our interaction. It doesn't come back easily. Everyone's affected by it. So I run into people like, oh, I'm depressed. I don't, when's this going to be over? I say, hey, get on a plane, take a trip, get in your car, go to a restaurant, go to a bar, see your friends. I mean, just get out there and try to get back to where you were, because if you don't, this will stay with you for the rest of your life. And that has economic impacts as well. So there's a physical side to it. There's definitely a mental side to it. It was almost unrecognized at the time I wrote the book. This is chapter 5 of the book, where I talk about the mental health aspects of this, but it is actually playing out that way. And the name for it now is called Long COVID.
All right, Jim, we're going to have to wrap out there before we run out of time. I highly recommend everybody buy your book. I'm going to pop a link below this interview so everyone can get access to both the new Great Depression and the new case for gold. Jim, as always, I just want to thank you very much for your time. I could, you know, pepper you with questions all day. But I believe it's time for you to go off and enjoy your Northern Hemisphere summer. So thank you very much for being with me today.
Thank you, Shae.